Well, obviously there's a lot of money chasing fewer deals, but it depends on where you look in the industry as to whether it has an impact. It might have an impact to the smaller firms. The larger firms, it really doesn't, because size is a discriminator, and also brand with respect to understanding an industry silo and the ability to close based on relationships, based on banking capabilities, et cetera, et cetera. The idea of certainty and knowledge gives a competitive advantage to the larger firms. We've been saying that there's a lot of dry powder out there for a long time. And sort of the question is, where do you invest this dry powder? And we've been able to expand our portfolio of opportunities around the world in a specific way, where most people can have difficulty accessing outside their own area of expertise. We've been able to create a diverse firm that also has a global footprint. And not only are we in the money center cities, but we're also in cities that are outside the capitals, where you first see the deals. So in terms of access, I think the idea of being able to be on the ground with people that are native to the country, with a financial network that allows those people to draw on the expertise across the firm gives a competitive advantage that goes beyond just the amount of dry powder. The money has to be invested somewhere, right? And so, you know, it's sort of a pecking order in terms of the credibility of buyers. And I would say not all dry powder is created equal. Generally speaking, publicly traded markets don't reflect the fundamental nature of the economies like they had in the past. So for example, stock markets are dominated in terms of value by digital and new age, information aged businesses. Looking at equity markets as a viable investment is knowing that you're going to be paying a premium that's sort of set by a different standard, and that is driven by the valuations of new age companies. Whereas in the fundamental economy, there's still a premium to be had in terms of value created. And so I think there is a shift toward private companies and private capital investing, because we're closer to the asset. We're not playing the trading game on boards, you know, on the stock market boards across the world. What we're doing is sort of fundamental stuff with our hands on the wheel, where we control companies or have a significant influence on companies, sitting on their boards day to day, rather than just sending in orders to your broker. With all of the dry powder out there, with all of the high valuations, it's difficult for investors to keep their money deployed. And that's the challenge that's trying to be met by permanent capital or things like permanent capital. Of course, the ultimate permanent capital is to take a company public, IPO, and you have permanent. But there are so many others. You know, you have REITs, master limited partnerships, registered investment corporations, business development companies, and even in the closed-end world of funds, you're seeing longer and longer investment periods and you know, longer terms in terms of the limited partnership itself. Our recent newly formed fund of Carlyle Global Partners has an investment horizon of 15 years. So it's trying to meet the challenge of how do I keep the capital deployed rather than having to make another investment decision every 3 or 4 years with serial funds you know, coming to the market. It could be as much as half. Of course, everybody has, you know, the real challenge for us as private investors is to marry the risk, return, liquidity, and tenor, length of investment that is the preference of our investors with the market availability of investments that meet that. So it's a constant process of trying to fit together the structures with the capital preferences and do that in a way that minimizes the drag on frictional costs like taxes and tariffs and things of that nature. So, you know, I would say it depends on how rapid the continued customization on the capital formation side of the business continues relative to the investments that are available for those investors, which really haven't changed much. And you have cycles and things of that nature. And you have the new economy versus the old economy and everything like that. But we know that. We know that. But what we are still dealing with is the dynamism of the changing needs of investors that are continually customizing and specializing their requirements in terms of fit to their capital return needs versus the market. You have to start tracking your potential stars early. You have to understand whether they're going to be the right kind of culture carrier. You have to know how they think. When I say know how they think, how do they separate the urgent from the important in terms of their prioritization of action. And you have to understand how they think about problem solving and such. But I would say in our transition, we're pretty safe. We have 2 of the 3 key transitional people that have been with us for more than 23 years. Our Chief Operating Officer and President, Glenn Youngkin's been with us for 23 years. He's a co-CEO. Our co-CIO, Pete Clare, has been with us 25 years under the tutelage of Bill Conway, who's our CIO. And our other co-CEO, Kyu-Sun Lee, has had 25 years of experience, 20 with Warburg Pincus, 5 with us. And he is already made his presence known by restructuring and moving our global market strategy business from a hedge fund orientation to a global credit platform that's scalable and integrated. Asia has become a much more important part of Carlyle over the years, and it's growing even more rapidly these days. We now have about 16% of our AUM across the firm in Asia, and we've grown from our first office here in Hong Kong in 1998 to now 9 offices across the region. Over the course of that period of time, you know, we've invested something like $15 billion worth of equity, which I think could be one of the highest amounts of any private equity firm in the world, certainly the ones that we know.